So today we'll be talking about topic 6, interest rates and bonds valuation. So what we're going to talk about is, I hope that you have your questions with you, and as usual, if you have any questions, please let me know on the chat box. So we'll go through the theory questions first, of course, then we'll go through some of the calculation later, then we'll see. If you have any issues, please let me know. So let's look at the first question here, 6.8. Companies pay rating agencies such as Moody's and S&P to rate their bonds, and the cost can be substantial. However, companies are not required to have their bonds rated in the first place, and doing so is strictly voluntary. Why do you think they do it? So here the question is telling you companies actually pays rating agency to rate their bond. So rating agencies such as Moody and S&P, why do they want to pay so much of money to rating agencies to get their bond rated? That's the issue here. Okay, so they are not required to do so. They voluntarily paying some agencies to rate their own bonds here. So why do they want to do this? Two main reasons to this. Number one, unrated bond is very hard to sell. Unrated bonds, hard to sell. Number two, large investors only buy rated bonds. So basically, two reasons here. Number one, unrated bonds very hard to sell. Okay, so to make it easier to sell, they need to sort of like do marketing. They want the rating agency to give them the rating, so the bond could be sold out. Number two, large investors only buy rated bonds. Unrated bonds are not allowed to be bought by large investors. So it's not they don't want to buy unrated bonds. They cannot buy unrated bonds. They can only buy rated bonds. That's the requirement for large investors. Okay, so now come to this scenario here. There's some questions might be raised in your mind here. What is bonds? So financing a company, there are two different techniques. Number one, it's via equity. Number two, it's via debt. So what is equity? Equity will be things like stocks. So a company want money, want to expand their business, they sell their stocks to people at a price. Okay, in exchange for capital, in exchange of more money. All right. Next. Next, debt. Debt here will be including bonds, loans, and whatever other possible debts that you can get. So bonds is basically you selling a package to someone else. Okay, you sell it, okay, or you get the money, all right, or you borrow the money from general public. So you repackage it as a bond and sell it to the general public to get the money, and you promise them a certain amount of payout, interest rates, and coupon payments. Okay, interest rate as coupon payments. Loans means you take a loan from a bank or whoever, then you pay them interest rates. So bonds, it's one component of that. It's one kind of debts. All right. So now moving on to question 6.15. 6.15 is broken into three different parts. The first part here, what is the relationship between price of a bond and YTM? So first of all, what is bond price? Okay, what is bond price first? Bond price is the present value, okay, when discounting the future cash flow. What kind of cash flow we are talking about here? What kind of cash flow there? So in a bond, in the timeline of a bond, Okay, in a timeline of a bond will always have a face value of $1,000. So at maturity, your bond will always be bought back at $1,000 face value. So a bond price is the present value. What is the value at time zero? And then this is the year, 5 years to maturity. Interest yield, it's also your YTM, yield to maturity. Okay, in bonds, we call it YTM, yield to maturity, but it's actually the same meaning as interest per year. Okay, so every single year, according to the company, like if they want to pay out the coupon payments in a monthly, in a yearly basis, is every year. If you semi-annually, every 6 months. If you monthly, every month. So here you are getting coupons coming in all the way until maturity. All right. So a bond price means basically discounting all these futures cash flow back to time zero now. Okay. You want to see what is the value today of the bond. So how is this related to YTM? What is YTM then? Like I mentioned to you, yield to maturity is the interest per year. So the relationship here will be the yield to maturity is the interest rate that you are using to discount your future cash flow to find your bond price. All right. So YTM is the interest rate used to discount the future cash flow back to their present value, which is the bond price. Simple, easy. So this is part A. So some of you might be still lost. Never mind. This version, this recording will be uploaded and then you can watch it later on. Okay. It's nothing rocket science here. It's basically discounting. Then when you watch it and you look back at my explanation, you will understand better. So B here, they're telling you there are 3 different bonds. So explain why some bonds sell at premium over par value while other bonds sell at a discount. What do you know about the relationship between the coupon rate and the yield to maturity? And all right, what do you relationship between the coupon rate and the yield to maturity for premium bonds, discount bonds, and bonds selling at par value? So 3 kinds of bonds. First bond, premium bond. Second type of bond, discounted bond. And third kind of bond, par bond. Okay, premium bond, discounted bond, and par bond. How these 3 bonds related to yield to maturity? How is the coupon rate of these 3 bonds related to the yield to maturity? So coupon rate is the percentage of payments you receive in a year. All right. So for a premium bond, the coupon rate will be what happened? Higher than the yield to maturity. All right. So the interest rate will be higher than the yield to maturity. Again, the return that they give out in a yearly basis is higher than the YTM. That is a premium bond. Okay. Then discount bond, your coupon rate is lower than your yield to maturity. Par bond, your coupon rate is equal to yield to maturity. So back to here, premium bond means the bond is sold cheaper than the face value, so expensive than the face value. So I told you in bond, the face value of $1,000 is fixed. In future, each bond will value at $1,000, but the price of the bond price will be different. So if it's a premium bond, this value at the present value will be higher than the face value. So a premium bond will have a present value higher than the face value of 1,000. That's a premium bond. So discount bond, of course, your PV will be lesser than your face value. Whereas for par bond, they are the same. Present value equals to future value. The coupon rate is equals to the yield to maturity also. So we'll look into this much more clearer when we do the calculation equations questions. Then I'll explain to you back into this theory. I'll relate it back to this theory. Then you can see what is a discount bond, what is a par bond, what is a premium bond, how to identify, what is the characteristic, and so on and so forth. So this is to summarize it first for you, to give you have an idea first. All right, look at this, huh? Don't forget this section. Okay. Next, part C. Part C, they want you to talk about the current relationship between current yield and YTM for all the 3 bonds. So first of all, what is current yield? Current yield is a formula. Current yield is annual coupon payment divided by bond price. This is the formula for current yield. Current yield equals to annual coupon payment divided by bond price. So what is the relationship between current yield and premium bonds, discount bonds, and also bonds at par value? Okay, for premium bond, your current yield is less than your yield to maturity. For discounted bond, your current yield is more than your yield to maturity. And par bond is still the same. Whenever it comes to par bond, everything equal. So the complicated part here is current yield for premium bond is opposite of coupon rate versus yield to maturity. Okay, so whatever it is, these are the characteristics of the 3 different bonds. So look at these, remember this what I've mentioned to you. All right, okay. Just remember when it comes to premium bond, the return they give it to you, the initial selling price of the bond will be more expensive, but the return in a yearly basis is higher. Discounted bond sold to you at very cheap price, so your rates, your payment in a yearly basis is definitely lesser than the market rate. YTM is basically your market rate, or we call this interest per year. Okay, par bond means everything equals. All right. So let's go through the question number 3 now. So far, before I go to the question number 3 to do the calculation, any issue regarding the theory questions? Come, I know a lot of you came in for today's replacement, all right, for tomorrow's public holiday. So if you have any questions, come on, address to me. Don't be shy. Anyone? So far, can follow, cannot follow? No issues. Very good. Anyone else? I see that the chat box is quite blank, so I assume most of you got no issues also. Claire say can, no issues also means. All right, very good. Gowing also no problem. So in that case, I'll move on then. All right, we move on to question 3 on the calculation methods. So listen to me carefully, yeah. Don't slack, don't run away, don't go and sleep first. Listen to me carefully. We finish early, then you can go and continue your sleep. No worries. So come, question 3 here. Lycan Incorporation has 7% coupon bonds on the market that have 8 years left to maturity. The bonds make annual payment. If the YTM on this bond is 10%, what is the current bond price? So they want you to find the present value of the bond. I told you, future value, even though it's not stated to you, a face value of the bond is always 1,000. Okay, coupon rate. Coupon rate given to you is 7%. Percent coupon bonds, coupon rate, that one is 7%. So you got your coupon rate of 7%, you can count your payment. Okay, your payment, the payout of your bond. So 0.07 of the face value. So each payment per year is $70. Okay, your yearly payment is $70. All right. So how many times they make payment to you? 8 years. Okay, 1 year, 1 time. So total 8 years, 8 time payment, and is the frequency of payout 8 years. Next, the YTM is 10%. YTM, it's also your IY. So this is 10%. 10% is 0.1. Okay, so you need to find this. So you put all this into a timeline, you will look something like this. Eight years, IY 10%, face value 1,000. Every year payment $70 until 8 years. Find the present value here. So this is how the timeline looks. You want to discount all of this cash flow for 8 years back here, and also discount the 1,000 discounted 8 years. What is the value at time 0? So now we come to the crucial point. What is the formula for bonds? Blue color. Formula for bonds is PV equals to PMT times with 1 minus 1 over 1 plus R power of T divided by R, close brackets, plus future value multiplied by 1 over 1 plus R power of T. Okay, this is method number 1. This is the formula number 1. If you want to do with your scientific calculator, you key in the figure and calculate with this method. Okay, FV times 1 over 1 plus R could also written as FV over 1 plus R power of T. Okay, method number 2. Present value equals to PMT multiplied by PVIFA percentage and N plus FV multiplied by PVIF percentage N. So this is using the PVIFA and PVIF table, which will be given to you in the exam. So I won't elaborate on this method for you lah. So you just if you want to use this, then you go and explore it yourself. Okay, the important one that I want to show you is basically method number 1 and how to use calculator with method number 1. So if you count method number 1, in this case, then you want to find PV is easy. You just key in your payment 70. 1 minus 1 plus R power of T 8 years divided by R 0.1 plus 1,000 divided by 1 plus 0.1 power of 8. What is your answer? Okay, so for those who use financial calculator, very easy. All right, you can put your FV equals 1,000. N is 8 years. Payment 70. Interest yield 10%. And then you straight away compute PV. So PV is 839.95. The present value is $839.95. Same with calculator. Okay, so this is the first calculation question. So how can you see what is bond or not? Okay, so you can see bond basically you want to find all this cash flow coming in for the next 8 years, discount it backward to time 0, and then the future value at the expiry at the maturity is 1,000 always, and this 1,000 you discounted back to 0. So total these two together, you can get your present value. The bond price is 839.95. So from this question itself, there's so many characteristics being shown to you. Okay, you can see from here, your coupon rate is 0.07. Coupon rate 0.07 is lower than your YTM of 10%. So when CR coupon rate lower than YTM, you know this is a discount bond. If this is a discount bond, your present value should be lower than 1,000. Indeed, it's lower than $1,000. Right? Pretty simple, right? Okay. So this is a discount bond. Okay. Now I move to question 4. Question 4 will be a determining factor whether students will end up buying a financial calculator or not. Why I would say so? Let's look at this. The Smart Choice PLC has a 10% coupon bond on the market with 9 years to maturity. The bond makes annual payment, so 1 year pay one time. If the bond currently sells for 1145.7, what is the YTM? So present value, the bond price is 1145.7. Coupon rate is 10%. 10% of how much? Of your FV. So your payment is 10% of 1,000. So it's 100. FV always the same value, 1,000. Okay. Left to maturity and equals to 9 years. They want you to find the YTM or interest per year. This is unknown. So if you put into a timeline, it looks something like this. 0, 1, 2, 9 years maturity. YTM, don't know. FV 1,000, always 1,000. And then your yearly payment is 100 that you receive. Find the present value. So if you use the formula, okay, you want to use a financial calculator, your formula will be replaced. PV is 1145.7 equals to payment 100. 1 minus 1 plus R, power of T is 9 divided by R, plus 1,000 divided by 1 plus R, power of N, which is 9 also. Okay, so over here, the problem is you need to find R. This is the complicated section. So to find R, that's impossible for you to calculate it simply or transfer around here and there. Also cannot get, you'll be much more complicated. The only way for you to do this is to identify what will most likely the YTM be. This one present value no need count. They already give you 1145.7. So you want to find YTM. So first of all, you want to know what kind of bond is this. See what kind of bond is this. So you see, the first thing you can notice is PV is higher than your FV. 1145 is higher than 1,000. So this is definitely a premium bond. Okay, a premium bond. So criteria for premium bond, your coupon rate must be higher than your yield to maturity. So here, coupon rate given to you is 10%. So yield to maturity should be less than 10%. So in this case here, you cannot calculate with your calculator. You cannot transfer, cannot move around. You can only use the trial and error method. So you try to put, your YTM must be less than 10. So you can try put 9%, 8%, 7%, until you find the value is 1145.7. That's the trial and error issues. It's going to be very time consuming. Okay, but if you have a financial calculator now, it make wonders. Why? FV is always equals to 1,000. Okay, PMT, it's all equals to 100. N is equals to 9. PV is equals to plus minus 1145.7. Then you just need to compute IY to get your answer. Okay, you just compute your IY, you get your answer 7.7%. All right, but if just now you use try and error, you try that 9, you cannot get 145. You try 8, 8 you see that is quite near. You try 7, is below this number, so it should be between 8 and 7. Then you try 7.5. Then it's also nearer to the answer, but it's lesser. So it's between 7.5 and 8. So you find until you get 7.7%. That's try and error method. Okay, that's the trial and error method. So this is the most, this is where the question started to convince students who are not interested with financial calculator will end up being a convert. Why? Because with financial calculator, it's easier. You don't need to trial and error. Okay, so up until here, any questions or any doubt? Or anyone lost? Are you guys okay? All good. All right, very good. All right, then I'll move on to question 5 then. Okay, I move to question 5. So what happened in question 5 here? Let's read the question again. Merton Enterprise has bonds on the market making annual payments. So every year they make payments. And then 16 years to maturity. N equals to 16. Selling price is 963. You see, selling price 963, face value 1,000. You know this is a discounted bond. All right, the bonds yield 7.5. YTM 7.5. Again, YTM is 7.5. And then what must the coupon rate be? So they want you to find CR. CR unknown. Before you find CR, you need to find the payment first. All right, so this is a discounted bond. A discounted bond CR will be lesser than YTM. So your CR must be less than 7.5%. This is the hint already given to you. So if it's in a timeline, you will look something like this. FE 1,000. Payment don't know. That's what you want to count. Person value 963. So this method, if you use the formula, all right, can 963 equals to PMT multiplied by 1 minus 1 over 1 plus R power of T divided by R plus 1,000 divided by 1 plus R power of T. So you can find your PMT. Okay. For calculator, PV plus minus 963, IY 7.5, FE 1,000, and 16 compute PMT. Okay, compute PMT. So both will give you the answer of $70.95. Okay, each year payment is $70.95 until 16 years. So you got your PMT. The answer they want is for coupon rate. So coupon rate very simple. Just take your PMT divided by bond price. So 70.95 divided by 1000 back. So your coupon rate is actually 0.07095 or 7.095%. So isn't this value lower than your YTM or not? Lower than 7.5, right? So the hint is already there. They already give you all the criteria. This is the criteria of a discounted bond. Okay, this is the criteria of a discounted bond. Can Okay. So now, I think no issues, right? No issues, then we move on. All right. Next two questions. We won't play with this bond equation anymore. We'll go to nominal and real returns. So this is talking about the Fischer effect. All right. This we are talking about the Fischer effect. So what is the Fischer effect, or what is the Fischer equation here? The Fischer equation indicates this: 1 plus big R is equals to 1 plus small r times 1 plus h. Okay, the big R here stands for nominal rate. Small r stands for real rate. H is your inflation rate. So this is the official equation to count fully for the Fischer effect. So there's another simplified version of the equation, which is nominal rate roughly equals to real rate plus inflation rate. This is the other formula that you could use. All right. Then look at the question number 11 here. An investment offer a 13% total return. Okay, so this is your nominal rate, a 13% of the total return over the coming years. Bill Bernanke thinks that the total real return, small r, total real return of the investment will only be 6%. What does Bill believe the inflation rate will be over the next year? So you need to find H. So if you use the first formula just now, okay, 1 plus 0.13, it's equals to 1 plus 0.06, okay, times 1 plus h. So 1 plus h is equals to 1.13 divided by 1.06. H is equals to 1.13 divided by 1.06 minus 1. So the H that you are getting here is 0.066 or 6.6%. Method number 2, 13% roughly equals to 6% plus H. So H is roughly equals to 7%. That's all. This is the Fischer effect. Very easy. All right, very straightforward, very easy. All right, look at the next question here. Question 12. Say you own asset that had a total return last year of 17%. If the inflation rate last year was 2.9%, what was your real return? Again, Fischer effect. So do again. 1 plus 0.17 equals to 1 plus R times with 1 plus 0.029. Okay, so shift that R over is 1.17 divided by, oops, 1.029 minus 1. So your R will be 0.137 or 13.7%. The second calculation, yes, what's wrong? Second question, 17% roughly equals to R plus H. Your H is 2.9%. So your R is roughly equals to 14.1%. So these are the two methods you use for the Fischer effect. Very straightforward, very easy. Okay. Can, huh? So done with most of the calculation. So now we'll go to our last question here. So what happened in this last question here? This last question, it's more like an exam question where they combine all the theories or all the formulas that you learned today. Okay, so let's look at the question together. PK software has 7.5% coupon bond. So your coupon rate, it's 7.5%. And on the market with 22 years to maturity and 22 years. Now this bond makes semi-annual payment. Oh, semi-annual payment means 1 year, 2 times payment. And currently sell the one later on. So the bond makes semi-annual payment. Okay, semi-annual means 1 year pay 2 times. So instead of 22 years, you times 2, total is 44 payments. Okay, you haven't count our payment yet. So our payment, it's our coupon rate 0.075 multiplied by the face value of 1,000. So payment is 75 divided by 2. All right, payment price per 6 months per year is 37.5. Okay, whole year combined, you get 75. Next. And currently sell for 106% of par. So FV is equals 1,000. The present value they say is 106% of par of 1,000. Or this is 1.06 of 1,000. So you should be getting 1060. Again, from here you can tell 1060 it's higher than 1,000. This is a premium bond. Premium bond CR definitely higher than YTM. Okay. Now look at the question. The question asks us 3 things. First, what is the current yield? Next, what is the YTM? And lastly, what is the effective annual yield, which is EAR? These are the 3 things that they want you to find. CY, YTM, and EAR. So to start first, we count current yield first. So current yield, you know the formula. It's annual coupon payment divided by bond price. Okay, so just replace this. This is simple. Annual coupon payment is 7.5, so it's $75 per year. Bond price is 1060. So your current yield will be 0.0708 or 7.08%. Done with current yield. Okay, next one. To count your YTM. To count YTM, you want to count what is the interest per year for each 6 months. Why? Because this is semi-annual. So the present value, plus minus 1060, future value 1000. Okay, PMT is half of 75 because you pay semi-annually, 3750. Your N, instead of 22 years, now is 44 payment, 1 year 2 times, so it's 44. Okay, so now basically you're counting for half a year. All right, then lastly, you compute your IY. The IY that you get here, okay, if you don't use this financial calculator method, then you need to use a try and error. So I won't tell you the try and error method, because basically you just fill into the formula and then you try to find your YTM. So in this case here, you know that this is a premium bond. A premium bond means your coupon rate is higher than your yield to maturity. So given to you, your coupon rate is 7.5, your YTM should be less than 7.5. So you need to start counting down. Okay, take any figure below 7.5 to calculate to see whether can you get back the 1060 or not in the equation. So compute the IY. If you use calculator, you straight away get your half a year interest rate. 3.482. This is for half a year. So YTM is for whole year. So 3.482% times 2. All right, you will get 6.96%. Okay, 6.96%. This is also known as your APR. I hope you still remember on 2 weeks ago's tutorial. All right. So the yield to maturity for semi-annual one, you need times 2 back. You get 6.96, which is the APR now. So once you got your APR, you can do the last question, which is finding the EAR. So EAR, it's equals to 1 plus APR. Oops. 1 plus APR divided by M, close bracket, power of M minus Y. All right. So just replace into the formula. 1 plus APR is 0.0696. Frequency per year is 2 semi-annually. Minus 1. So your effective annual rate, all right, should be 0.0708 or 7.08%. Those who use financial calculator and you forgot how to do it 2 weeks ago, all right, first you need to reset. Okay, after reset, I convene nominal 6.96, enter. 2 arrow down, okay, see your CY, 2, enter. Arrow up 1 time, compute EFF. You will get 7.08%. That's your effective annual rate. So from this equation, from this calculation, you already know that your YTM of 6.96%, okay, YTM is smaller than your coupon rate because this is a premium bond. And it's exactly as simple as that. So I think for those of you who never used a financial calculator before this, after today's class, you can realize, or you realize that your financial calculator save a lot of time. Okay, so it's actually, if you don't want to invest in it because of it being pricey, it's up to you. So, but you can always ask for those friends who already have it. Okay, you can borrow from them